Welcome to this deep dive for the Stoxfeed YouTube channel. Before we jump in, a quick disclaimer. We are not financial experts, right? This is a strictly neutral, objective look at the data.
Right. Definitely not financial advice.
Exactly. But if you do enjoy this analysis, make sure to hit that subscribe button. So today's mission, we are unpacking a report on Dycom Industries, ticker DC, honey. It's currently sitting at around $351.80.
Yeah, they're a major telecom and utility infrastructure company.
Right. And it's showing this really wild contradiction, between Wall Street hype and the underlying technical realities. It's kind of like, imagine a movie getting perfect reviews from critics, but struggling at the box office.
That is a great way to put it. I mean, Wall Street absolutely loves this stock right now. You've got 11 analysts giving Dycom a unanimous strong buy consensus.
Wow, unanimous.
Yeah, completely. And they're setting an average price target of $637.27.
Wait, so from 351, that's what, like an 81% upside?
Almost exactly 81%, yeah. And, the fundamentals do show solid long-term returns. It's up, I think, 363% over 5 years.
Right, and steady revenue growth, too. The data shows 17.9% year over year. But I guess my question is, if the upside is really over 80%, what are the analysts seeing that the current $351 stock price just hasn't priced in yet?
Well, it mostly stems from Dycom's projected EPS growth. They're modeling 17.7% growth by fiscal year 2027.
Okay.
Because they have this really strategic position in building critical communications and, data center infrastructure. The analysts basically look at the blueprints for this massive AI and data center boom and think, this is going to be beautiful.
Right, right. But if those blueprints are so flawless, why does the underlying technical data suggest that the foundation is, well, currently cracking?
And that is the tension driving this entire report. The forward-looking fundamentals show all this strength, but the DVM scores, durability, valuation, and momentum, they paint a very mediocre present.
Yeah, the scores were pretty rough.
Yeah, they sit at 50, 43, and 40 out of 100. And that 40 in momentum is really critical.
Why is that?
Because mechanically, it tells us that despite that 81% projected upside, there is zero immediate buyer urgency in the market right now compared to broader indices.
And the valuation piece is even more glaring to me. The data flags a PE sell zone. Dycom is currently trading at a PE of 33.9, and historically, it has spent 72.5% of its time trading below that multiple.
Right.
But push back on this for me. Doesn't an accelerating macro trend like the data center boom, doesn't that justify a higher premium? I mean, does this historical trend actually mean the easy money has already been made?
Well, a strong macro trend can justify a premium for a time, sure. But extreme deviations from historical norms, they eventually require flawless execution to maintain.
Makes sense.
If a company spends 3/4 of its life cheaper than its current price, any minor hiccup in that projected EPS growth is going to cause the multiple to aggressively contract.
Wow.
Yeah, the margin of error is basically zero at a 33.9 PE. It leaves the stock highly vulnerable to any shifting winds.
Which really explains why the technical traders seem to be fleeing. I mean, it's not just a high valuation. The actual price action is breaking down. Dycom is trading below all 8 of its simple and exponential moving averages.
And that matters because moving averages act as structural support levels. When price action slices down through all 8, you're looking at a complete failure of both short-term and long-term price floors.
Right.
Plus, you pair that with a MACD of negative 11.5.
That's pretty bad, right?
Yeah, it isn't just a red number on a screen. It means the short-term moving average is aggressively diverging below the long-term average. The downward momentum is actually accelerating.
And then there's the RSI, which is sitting at 31.8. Now, usually, retail traders see an RSI approaching 30 and think, oh, oversold, time to buy.
Right.
But in this context, it is measuring the sheer velocity of the recent sell-off. Selling has been so aggressive that the stock is exhausted.
Exactly. When you combine that with failing moving averages, that RSI isn't a buying opportunity. It's a sign of severe structural weakness. Overall, the Trendlyne checklist only shows a 55% pass rate.
Wow, only 55%. So you are looking at a market that is structurally rejecting the current price level, regardless of what the long-term Wall Street models say.
Precisely.
So as a potential investor, I mean, maintaining our neutral stance here, should I even care about a negative MACD today if the multi-year infrastructure trend is so strong? Like, if they're right about 2027, isn't this just short-term noise?
It depends entirely on how much pain you're willing to hold through.
Ah, right.
The analysts are pricing in the final destination. The technical data is mapping the immediate road to get there. The destination might be structurally sound based on future earnings, but the technicals are warning that the entry point right now carries massive downside risk.
Before that future's even realized.
Exactly.
Which brings us to the ultimate tiebreaker. And this is a massive puzzle for everyone watching Stoxfeed to mull over. According to the data, mutual funds currently hold 58.9% of Dycom shares.
Yeah, that is a massive block of institutional ownership. It's an incredibly crowded trade.
Right. So here's the provocative thought to leave you all with today. Does that heavy institutional backing act as a safety net, like a concrete floor stabilizing the stock against these bearish technical warnings? Or if those mutual funds suddenly decide the PE is too stretched and they start following the technical warnings to sell, could that crowded theater turn into a massive stampede for the exits? Let us know what you think in the comments.